won't come into play. Not that they won't come into play, because they will. If they're there, they will. But at least in the mechanical mode, you know exactly what you need to do and when you need to do it. So any thought of deviating from that, you know there's a problem. I'm going to get some perplexed look on it. I'm going to go into all the detail. I'm just giving you an overview here, okay? So don't get too perplexed. Go ahead. Oh yeah, the fear of being wrong, the fear of losing, missing out, leaving money on the table. So you don't have to reach that level of awareness, that, let's say, heightened level of awareness to be able to be successful. But you better be at that heightened level of awareness if you don't want to create disastrous results in the subjective mode. Most people are trading outside their skill level, meaning they should be trading mechanically and they're trading subjectively. They're trading in the discretionary mode, and they have nowhere near the skills to be able to do it. Because in that mode you can do whatever you want. See, in the mechanical mode, I would say you wouldn't even to think about pulling a stop, even to think about moving a stop is a trading error. In the subjective discretionary mode, you want to move a stop, move it. You want to pull a stop, pull it. Because the assumption is you're not doing it from a state of fear. You're not doing it because of what you're afraid of the results are. You're doing it because that's what the market's telling you to do in this moment, based on your ability to read the market from an objective perspective. Because every mistake, just about every mistake that you can make as a trader, will be the result of, I'm afraid of being wrong, I'm afraid of losing money, I'm afraid of missing out, I'm afraid of leaving money on the table. You're going to get in too soon, you're going to get in too late, you're not going to define your risk because you're thinking, hey, why define the risk? I know we can get in this trade and I think it was going to be a winner, so there is no risk. Yeah, oh, okay, yeah. Or you say, you read all the books and you go to the conferences and say, hey, don't do this without determining what your risk is before you get into a trade. And so you think, okay, well, I've got to, everyone says I got to do it, so I'll do it. So basically, it's lip service. Lip service in the sense that, okay, you'll put a stop in the market, and that's where usually people use percentage stops as opposed to what I call structure stops. Structure stops are where you're actually reading the market in a way where, where's the best place from a structure perspective that tells you this trade isn't working, or the likelihood of it working is so diminished in relationship to the profit objective it's not worth staying in anymore. Did you guys get what I just said? Okay, that's a structure stop. When you pick an arbitrary percentage stop like 1 or 2%, that's people that do that usually that's risk. That's lip service risk management. They really don't believe they're going to get stopped out, but they've been told over and over again you got to do something like that, and so they put their percentage stop in the market and thinking, well, it's never going to get hit anyway. And of course, when it starts to look like it's going to get hit, they'll either pull it and put it somewhere else, or if they're coming out of a state of basically pain where they've lost 3 or 4 trades in a row, if it starts even getting close, they'll pull it thinking, I'm going to save myself some money. Nobody in this room done that? Oh, okay. Yeah. Today, yeah, right. It could be anything, yes. A structure stop could be. The question is a structure stop like a 2-bar stop? A structure stop is based on your definition of an edge. We have edges for getting in. We have edges for getting out. Whether the edge is defined as a profit objective or a place where the market's telling us that the likelihood of this trade not working is so great it's not worth spending any more money on, or not worth. In other words, the likelihood of it even hitting the profit objective is so diminished that it's not worth spending any more money on. Go ahead. No, not in this business. Zero fear. Absolutely zero fear. Absolutely zero fear. I want to be emphatic about that. No, there is no, absolutely zero fear. You have got to trust. This is a good question. Thank you very much. You have got to trust yourself, because what you're going to find when I get into this example is that fear acts on our perception of information in a way that we actually create the very experience we're trying to avoid. Okay, I'm gonna explain how that works. But fear will act on our perception of information, how we perceive it, the way we filter the information, and how we behave in a way where we will actually create the very experience we're trying to avoid. So if I'm trying to avoid being wrong, that's exactly what I'm going to end up doing. I'm going to act and see things in a way that create a situation where I end up being wrong. If I'm afraid of losing money, that's exactly what I'm going to create for myself. Zero fear. Not only that, you have to, because fear and trust are opposite of each other. You've got to be able to trust yourself. You have to be able to completely and absolutely trust yourself that you can act in your own best interest and do the right thing without experiencing pain first. How can you be successful in this business if you have to experience pain to get out of a losing trade? That if it takes that much, in other words, the market has to go so far against us that we can't stand it anymore, that we eventually get out. Go ahead. No anxiety, no fear, no, completely carefree state of mind. You're going to have to get to the point where you're in a completely objective, carefree state of mind. You cannot care about the outcome. Remember I started, it wasn't even that long ago. It's detached from the outcome. You got to get your expectations in line with the reality of the environment you are operating in. You are operating in a probabilistic environment. That really means, not lip service, that really means probabilistic. Maybe I'm going to get the outcome that my edge says or my edge is predicting will happen. Maybe. I'm going to prove this to you. He said, one of the reasons why I wrote this third book is because I came to the realization that my personal experiences as a trader starting out, because I started trading in 1978. So my personal experience as a trader and then going to work for Merrill Lynch at the Chicago Board of Trade as a retail broker, it's like I ended up learning things about how the market works that ordinarily, without being on the inside of the industry, people just wouldn't get. So I also took that for granted. And what people don't get is when they don't understand order flow, when they don't really understand the nature of order flow and how prices move from an order flow perspective, it's very hard to learn how to think. It'd be very hard to, let's say, extrapolate what, watching prices move on a screen in a way where you could think, well, I need to think like this, I need to think like this. So when you don't understand order flow, that really screws you up. Because when you really do, everything that I'm saying will become self-evident. When you understand order flow, all the things that I'm saying will just yeah, okay, yeah, that makes sense. So if I say to you that if you operate, you've got to get your expectations in line with the reality of the environment that you're operating in, it means you don't know what your outcomes are going to be. There's no way you can know what your outcomes are going to be. I'm also going to say that you don't also know why you're winning or losing. When you understand order flow, you will know that there is no way that you can know why you're winning or losing or even find out. Think about that one for a second. You don't know why you're winning or losing, and there's no way to find out. You understand how prices move to the extent where you can think to yourself, yeah, okay, that makes sense to me. I'm going to explain it to you, but does it make sense now? And the implications of what I just said is that every prediction your methodology makes, in essence, is a guess. And if it's a guess, the implications are, guess what? You're gambling. What's that? If you're guessing, you're gambling. That is the reality of our situation. We have no assured outcomes, and we cannot make a connection between the reasons why we put on a trade and the reasons why the market went in our favor or went against us. If we can't make that connection, then we don't know why we're winning or losing, and it isn't any different than sitting down at a blackjack table or playing a slot machine, because there's no way to know. We are gambling. Regardless of the fact that you're using analysis, regardless of how good your analysis is, I don't care how sophisticated it is, there is no analysis that can take the gambling element out of trading. Listen to me. There is no analysis that can take the gambling element out of trading. There is no analysis that can eliminate the risk. There is no analysis that can assure us that this trade is going to be a winner. When you understand order flow, you will agree with what I'm saying. And then you'll start thinking about this whole thing differently. So instead of trying to avoid the risk, instead of trying to use your analysis to avoid the unavoidable, to do the impossible, you will accept the risk and understand it from a probabilistic perspective, and then everything will change. Everything will change. You'll even see a different market. You'll see the same bars, but you'll be interpreting it in a way where it's like, oh yeah, okay, that makes sense. Yeah. It's like, one second. It's like, we're here in Las Vegas. How to casino? You heard John say, or somebody, maybe yesterday, or I think somebody said, about even trading in zone. It's like, like be the casino. Well, here's what this means. Like, casinos know that they have the law of probabilities working in their favor. The law of probabilities is like magic. See, the casinos really aren't gambling. Because they are gambling in one sense and gambling from one perspective, but not in another. On an event-by-event basis, this blackjack hand, this blackjack hand, this blackjack, every individual hand that's dealt, they don't know the outcome to, and in essence, they are gambling on the outcome of each individual hand. But since they have the law of probabilities working in their favor, what that means is that over a large series of events, they will always come out net winners. So in essence, they're not gambling. We can do the same thing as traders. Exact same thing. We have an edge. Our edge gives us a higher probability of one thing happening over another over a series of trades. But each individual trade, the outcome is not known nor knowable. All I have to do is execute that edge flawlessly every time, and I will come out a net winner. And in essence, over a series of trades, I'm not gambling. On each individual trade, I am. Are you guys with me on this? I'll explain it in more detail later on. There is nothing you can do to take away the risk. Burn that in your brain. There's nothing you can do to take away the risk. Any effort that you put towards taking away the risk is going to assure you of failing. To whatever degree you're going to try to take away the risk of being wrong, the risk of losing money, the risk of leaving money on the table, the risk of missing out, all these four fears will detract from your ability to create a consistently rising equity curve and cause you to make mistakes. Okay, go ahead. Who had a question back there? Go ahead. Well, I don't know how you define a good poker player. I'd have to know how you define I don't know how you define a good poker player, so it'd be hard for me to answer that question. What's that? Well, yeah. See, winning one night, or and getting on a winning streak is different than someone who can gamble and make a consistent income. People who can make consistent income gambling, work basically off the same kind of mindset. And they also there's a lot of other variables involved. It's like people who are immersed in gambling. I mean, there's a lot of dynamics in play that are not so much different from a psychological perspective. But for example, if I don't gamble. I mean, I don't play blackjack anymore or anything else like that. But anyway, it's like if I were, what I would do, the first thing I would do is I'd walk through a casino and I try to find a dealer who's having a bad night. In other words, a dealer who's busting on a consistent basis. Or if I was playing craps, I would peruse the table until I found somebody who was hot with the dice. Because I do believe in streaks. I believe in winning and losing streaks. And if you can, and if I'm playing my cards right, if I've got a basic strategy on how I'm going to play my cards, or how I'm going to bet at craps, what I'm going to want to do is I'm going to want to, find somebody who's already on a streak or looks like they're going to be on a streak. In what way? If we flip the coin 1,000 times in a row, okay, we would come up with a pattern, a discernible pattern where there would be very little difference between heads and tails if the coin is evenly weighted. Right? This is the pattern that would come up over and over and over again. You could actually bet on it. You could actually bet on the fact that if I flip the coin enough times, like 1,000 flips, that the relationship between heads and tails would be within 1%. Right? Let's see. But within that 1,000 flip sequence, can you have winning? You could have heads. Could heads come up 10 times in a row? Yes. Yeah. Okay. I didn't say it was predictive. What I'm saying is I'm just looking for people. I'm looking for situations where it's likely that this is if someone's on a winning streak, they're on a winning streak. I don't know how long it's going to last. Or why? I don't care. I'm just looking for edges. That's all I'm saying. So to answer his question about gambling, it's not a good correlation because there's too many other factors involved. So, but otherwise, I'm just looking for that kind of edge. Go ahead. Yeah, I will now, but the whole rest of the time is going to be pretty much elaborating on it. When I say be comfortable, you say be comfortable. I say that you accept the risk at such a core level of your trading personality, of your trading belief system, that there is no other part of your mental environment that would argue for anything different. In other words, what I mean is that when you've accepted that I can put this trade on, I do not know what the outcome is going to be, I don't care what the outcome is going to be, because I've adopted a series of trades perspective, meaning that I don't know. Basically, what am I expecting? I'm expecting wins and losses over a series of trades. And I don't know the sequence of wins and losses. But I do know that my edge in the past has produced, let's say, a 60% win-loss ratio or a 70% win-loss ratio. Again, I don't know what the sequence to wins and losses are. And I don't care. I just need to execute properly. And when I get to the point where I really have accepted these principles, accepted them at the very core of my being, I will be able to do this without fear. I'm going to show you how to do it tomorrow. But what I'm saying is that this is where we're getting to. We're getting to the point where if you're going to do this right, you gotta transcend your fears. And to transcend your fears, you're going to have to learn how to think differently. It's that simple. If you're not willing to learn how to think differently, you might as well walk out of the room now. It's not going to happen for you. It really isn't. Go ahead. And there's enough back case of people who have been in this business for years, who have lost one or more fortunes, until they get to the point where they come to the realization that, you know what, my life strategies don't work in this business. Why do you think there's this theme in all really good traders, this theme that most of them had lost one or more fortunes before they finally broke through the threshold of being able to create consistent results? Because that's what it took. It took losing all that money to break down the resistance of their dysfunctional beliefs about the nature of this business, or their erroneous assumptions about what this is about. And most of those erroneous assumptions have to do with analysis, which is normal, because when you think about the way we define analysis in our normal everyday life, if I step into and engage in an analytical process, and I really believe that process has validity, then when I come to a conclusion, I should think that I'm going to get the outcome I expect. Wrong in trading. That's not the case. You don't open up a trading account at a brokerage firm and they tell you that, you know what, whatever you think, the way you define analysis doesn't work here, does not work. You're only using analysis to get an edge. And an edge is a higher probability of one thing happening over another. And if there's no way to assure myself that this trade I'm going to get into is a winner, I'm guessing. And if I'm guessing, I'm gambling. They tell you that? Anybody ever tell you that?
John?
Yeah. Okay, John. John's a good guy. Okay, I'm sorry. Yeah.
So go ahead and get involved in contracts or something because of the asymmetrical thing and reducing the risk. That's part of your strategy. You're not eliminating risk.
No, you're not. No, you're never eliminating the risk. You're accepting it. You're never eliminating it. There's nothing. Just you have to get to the point where you're just, like I said, there's no question in your mind that the risk always exists. Now, when you say eliminating the risk by scaling out a yeah, well, but see, there's a difference between what you say is reducing risk from a money management perspective and actually accepting the risk. When you reduce risk from a money management perspective, it's because the market's telling you, one, that's your strategy, okay, and two, the market's saying this is a good place to take some profits. That has nothing to do, I mean, you can say, the vernacular is, you can say, yes, I'm reducing risk, but that's not what I'm talking about. I'm talking about from a psychological perspective, actually accepting the risk, okay? So yeah, there's a difference, but these are subtle differences, and these are the kind of thing that gets us in trouble. See, when we don't understand these subtleties, we can get into a lot of trouble. Go ahead. Do I what? No. No, I really know what the squeeze is. So I haven't been trading in a long time. As a matter of fact, I turned my trading. I use TradeStation. I turned my trading platform off really just about 3 years ago, right around this time, thinking that, you know what, I don't want to be distracted with the market. I'm going to be done in 3 months. And I'm still not done, and I haven't turned it back on. So I don't even watch the markets right now, anyway. Yeah, as a matter of just to tell you what, maybe I shouldn't say. I don't know. I'm gonna say it anyway. I'll give you an example of what I'm talking about. Where I'm at right now in the book is the last chapter, and I'm actually writing about subjective discretionary trading. It's taken me like 26, 27 days just to get the first 3 paragraphs. What's the name? I know you're going to ask. I've got about 20 names. When I'm done, I'll pick one. Okay? When the name comes, I write it down, and if I can find the file, because I haven't thought of the name in a long time. I'm going to have to find the file, because there's like thousands of files. But anyway, it's like, and when I say I worked, it's not like I haven't been writing. I've got pages and pages and pages. It's just that the words have to come together in just the right way for people to really get it. And it's not until it resonates, it resonates with me that, yeah, okay, I've got the sequence of the words just right. And like I said, the 25, 26 days just to get 3 paragraphs. And if you had asked me a month ago, I'd have said, hey, I'm almost done with it. I'll be done in a few days. And what really scares me is the next part is intuitive. Now, I've already got a lot of the stuff on intuitive written, so all I got to do is find it. But then again, no, seriously, I'm not kidding, because I've written it years ago. So, I'm going to have to find what I've written. I'll find it. I mean, it's not like it's lost, but, I don't want to get into it. Anyway, so where are we? Yeah, right. No, exactly. It's, it's my own problems with the whole writing process that, creates all the difficulty when you get right down to it. I never, because I didn't grow up to be with the aspiration of being a writer. Do you really? Or an author? Or have any idea what that was like? Or here I'm almost finished my 3rd book, spent most of my adult life writing books, and I'm like, it's like, I just wanted to be a professional hockey player. I'm not kidding you. I'm really not. I grew up in the 60s or in the 50s, because I'm 66 years old, so it's like I grew up in the 50s, and back then there were only 6 NHL teams, and there weren't any American players any American hockey players in the NHL. There wasn't not one American hockey player in the NHL. So my chance of becoming a professional hockey player was zero. But all I'm saying is that my aspirations were to be a professional hockey player. That's what, and to be a writer, it's like, come on. I used to, this honestly got true. When the term, I went to Michigan State, and the term would start, and I go into a class, and the professor said, we're going to have a term paper. I'm out. Go my advisor, drop the class. Writing, forget it. I avoided writing at all costs. Now I know why. My life purpose was to be devoted as a writer, and I was just avoiding what I was going to end up doing. I didn't. Why start it back? Why start it when I'm in my late teens and early 20s? I'm going to end up spending my whole life doing it. But anyway, go ahead. You know what? These are all personal, individual variables, and it could be anything. I mean, just even, is John here? John. Okay, we were talking last night, in the cocktail thing, and John brought up that he made a connection. You want the connection about being a hero?
So it was interesting last night. We were talking, and as I was going through this kind of it's always a lot of fun living, disasters in your life. And
really, yeah. When you're on the other side of it, yeah.
And as I was talking about it, it was a period of time where consistently taking my early 20s, taking $10,000 and budgeted it up to 100 to 130. And I've talked about this before, right? In one smart way, right? I get to 130, I would take $30,000 and go buy some real estate. And then the logical explanation in my mind was, well, they'll take 10 and turn it into 100, so now I'm going to take 100 and turn it into 100. See? I mean, so think logical. And the first time I did that, 6 weeks later, I was back to 10. I don't really know what happened. And then it's like, okay, so I, took it off. About a year and a half later, I was back up to 120, 130. Again, in one start thing, took that down back to 100, took that money for real estate, down payments, 100 questions, stuff like that. And then I'm like, all right, so obviously the market got me at other times. So now, I took it from 10 to 100, and now, I was working and going to school. And, okay, so now I'm going to go from 100 to a million. And in my mind, this million was like a big thing. It was like, well, that's financial freedom. That's, I can quit my job. That's all I do. 6 weeks later, I'm back in. It's like, man, the market got me again, right? And so we go along. The third time was the worst. Was the, at this point, it was like a good-sized trading account, about $130,000, $140,000. I was fully weekly income out of it. Had a job. I was making $3,000 a year. I was ready to quit. My wife and I moved up at the time of we moved up to Minnesota in January with the job transfer. It was 30-0, and she said, look, you're right, all, but we don't have food. And so the car was parked outside. Like, we don't get a garage, a house. And I was like, okay. So I found a house, $30,000 down payment, and I had to figure out my trading account to do it. I really had this in my mind that I was kind of like, I really like my trading account balance, and I don't want to use it to buy $30,000. So I've had to do a couple of extra trades, make $30,000. And then when I pulled that thing out, my trading account balance did the same. Okay, so that was kind of the same idea. And so I did that, and it was like, this trade I didn't etch in my mind because I bought 148 puts at like $8, so $8,000. And this was like in 1995. Nice downturn in the markets there. And then, at one point, the premium dropped. And toward the end of the day, and they came down like $10. I was like, wow, I liked them at 8, I love them at 7. So we had to put the rest of the account at 7. And remember, I was only trying to make $30,000, and then it closed. I was up like 7 or 8 times. Like, wow, you think you're looking at that morning? I was really about it. So the next morning, I wake up, I turn on the ABC, and I should go apartment, and there was a green arrow, and the 136 packed out points up. So, naturally I turned off the TV and should go to the honestly, that's not a live shot. I need a live shot. And turned back on down, like 136 points. I'm like, okay. Now at this point, I've been trading long enough to know, like, okay, so this obviously is trading for work. When we come back down to half a gap fill, which is a high probability, I'm going to get out of our trade, I'm going to end up losing that trade. I'm like, let's learn. I would never ever do that again. So now I got to trade it sideways, but I've never seen such a sideways market. And at the end of the day, it was, wrong way. And the next morning it got up and rallied. The next morning it got up and rallied. And I've never blacked out in my life, but I don't remember that period of time after that. There was like 4 days. And I woke up suddenly and realized the next day was closing the house. I'm like, I have to sell it. Go to my account. And I sold it, and my account was like $140,000. So then I would take $30,000 out of the house. And at the time, it was just very clear to me that, you know, I did not go tell Maria what happened. So I maxed out my credit cards, got money, went to closing, the money in the account. Everything was going fine. But at the last minute, you know, the lady was checking my people and said, you know, you said that you were going to put $30,000 out of your investment account. But it came from your checking account. We just need to see the wire from your
jeez.
So at that point, I just decided that the best course of action was to be stupid. And I said, I don't want to do it. So we were back and forth for 30 minutes, and I'm like, I don't understand what you're saying. Finally, I got frustrated, and somebody's like, tell me how that happened today.
Wow. Worse than I thought. But you know what I want you to get to, though? Was applying, okay, yeah.
So after this, I'm having like a really hard time with this. I'm going like, I really want you to look at, I cannot do this. I need to find out what's going on. That was not going to across this trader. And as I was reading it, I mean, it was just kind of like going, wow, this is what was right for me. And what I realized out of it, and this is, you know, over the course of looking over it, is that there was something naturally heroic in being able to survive that. And somehow I firmly believe that subconsciously creating situations where I can be a hero. And how heroic is it to lose every penny of capital that you have and still won't be able to buy a house? Right? No bullshit with that. And at the time, that obviously wasn't going through my mind at the time, but looking back at it. And another line, I mean, it's like one of those, okay, you know, you kind of grow up, and everybody kind of has issues like, okay, parents divorce, okay, dad was good. So, you know, the things that, you know, maybe I wish I could have done something to help out. And I was replaying that out of my trade. So, but once I realized that, it stopped happening. So that's, you know, that's one of those things where it's, you know, it's kind of hard to like, you know, it's one of those things that hard, you know, it's hard to point at and, you know, but yes, that's what happened. But I'm like, once I realized it, it stopped happening.
Yeah, thank you. That's exactly what I wanted. He was applying his own agenda. In other words, he had another agenda other than just being a successful trader. So that's why I couldn't answer your question about, you know, well, what's happening with people because there's all kinds of agendas that we have. And when we trade in mechanical mode, it's at least a lot easier to be successful because we know exactly what we need to do, when we need to do it. Any deviation, we're making a trading error. In the discretionary mode, there's no such thing as a trading error because you can do anything you want. But then what you have is you have all these personal agendas that can really start to assert themselves. You can have personal agendas asserting themselves when you're in mechanical mode, but again, at least you know something is going on because I'm not executing properly. I want to make I'm about ready to do something that is defined explicitly as an error. And so at least if you got enough presence of mind to say, you know what, I'm going to step through that compulsive behavior and do what I need to do anyway, you'll be all right. But when you're in the discretionary mode, these agendas can assert themselves in a way that, unless you have a really high level of awareness, you don't even know what's going on. Making sense? Okay, that was the like the introduction. As a matter of fact, you know what? Before I get going again, why don't we take a 5-minute break, a bathroom break? Is that all right? Everyone with again? Okay. What I want to kind of want to get into now is to start building a foundation for understanding that not only do we not know what's going to happen next, there's no way to know. Literally, there's no way to know. It doesn't seem the industry isn't set up that way. The industry is not set up that way to allow you to think that there's no way to know. But I'm going to prove to you that there isn't. There isn't a way to know. And the problem, and the thing is, when you really grasp why you can't know, then you won't think that there's some way to eliminate or reduce the risk. Because if I go into a trade, for example, if I do my analysis, I stepped into this analytical process, and I come to a conclusion. My analysis makes a prediction. I put on a trade. The trade works. Is it not going to be natural for me to think that the market is moving in my favor for the same reasons I put on the trade? For the basic screen-based trader, like we are, okay? Now, I'm not talking professionals, I'm not talking fund managers or whatever. For the typical screen-based trader, that is almost never the case. There's almost never a relationship between the reason why you put on the trade and why the market went in your favor. And even if there was a relationship or correlation, there isn't any way for you to find out or prove it. Zero. That means that you don't ever know if your analysis is ever right. It'll be right in terms of, you'll know if it's right if it made the right prediction. You won't know if you had the right reasons for making the prediction. And if you don't know that you had the right reasons, then there's really nothing to be right or wrong about. Because one of the primary fears of trading is I'm afraid of being wrong. Hello, there's nothing to be wrong about because you don't ever know if you're ever right. See, when you start understanding the nature of this business and the way it really works, you'll start shifting your perspective and say, you know what, there's nothing to be afraid of here. I can't prove if the reason why the market moved in my favor was the same reason why I put on the trade. And see, the problem is, as soon as I think that I know the reasons why the market moved in my favor, I will just naturally assume I can duplicate the process. It'll seem as if I'm in this winning trade. I know why I put the trade on. I'm assuming that the market's moving in my favor for that same reason, allowing me to think that I knew what was going to happen. And if I knew what was going to happen, then guess what? I've eliminated the risk. That is the most dangerous thought you can think as a trader. Is thinking you've eliminated the risk. The worst case scenario in thinking that we've eliminated the risk is a condition called mind freeze. Does everybody know what I mean by mind freeze? You think you know what's going to happen. You've got 3 or 4 winning trades in a row. And it's like, hey, I get the next signal. I got this. I got the market by the balls. Okay, I'm going to load up on this one. So instead of being, a 100 share trader, you move to 1,000 shares or 5,000 shares or 10,000 shares or whatever. So as you make this money management error, in other words, you are now stepping into the realm of trading far more than what your account size would say is prudent. All the market has to do is go against you just a little bit. Just a little bit. And because we're so, in other words, our level of commitment based on our trade size would be corresponding or correlated to how convinced we are that the market's going to go in our favor. So that just that little bit against us, and we go into a state of mind freeze. In other words, our expectations of what's going to happen are so far away from the reality of the situation that our minds cannot process the experience appropriately. It shuts down. And as a result, we sit there and watch the market take our money away as the market moves against our position until like an innate sense of self-preservation kicks in. But that level is different for everybody. That level of self-preservation, where our minds kick in, that self-preservation mode, where it kicks in is going to be different for everybody. And we just like snap out of it and get out of the trade. Or like to say we're losing $1 more. Losing $1 more is 1 degree more painful than admitting that we're wrong. Okay? In other words, everyone has life experiences, memories that fall into a general category of what it means to be wrong. Like this is these would be negatively charged beliefs. All the ways that we can be wrong in our lives. That if we have experiences that tap us into this pain, we will experience it. All the beliefs and all the experiences that we have that go into our memories, just in a general category of what it means to lose, this is all negatively charged, painful, emotional energy. When the market takes away, in other words, it is more painful to lose $1 more than it is to admit that we're wrong, is when we'll get out of that trade. This is not a good way to trade, people. This is not going to assure you of success. Again, like I said a little earlier, we have to trust ourselves. We cannot be. Most people never recover. The traders that I work with, I would say that for the most part, most people never recover from it. They can if they really want to work at it. I'm not saying they can't recover from it. I'm saying that they don't want to do the work. They don't want to process. They don't want to go step into the process of what it requires to do the work to recover from a mind freeze experience. I'm not saying they don't keep on trading, but they're so damaged that because mostly when people experience a mind freeze experience, understanding the underlying dynamics of what caused it and what caused that pain, what do you think they think their way out of it is? How do you think they're going to compensate for it? More analysis. And then, of course, the more analysis, the more possibility of analysis paralysis. And the next thing you know, people spend years, learning how to read the market. They become absolutely excellent analysts. They really do. But they can't put on trade. because there's just too many variables to consider. And one of those variables that I might have overlooked is the one that's going to cause me to lose. And so therefore I can't get past the fear and put on trade. So okay. So what we're going to do is what I'm going to do is basically give you some. This is sort of a little bit of evolution of how I came to the point where I recognized that we don't know what's going to happen next, and the risk always exists. And these are some of the things, like these experiences that initially happened in my life that I really kind of just that I took for granted. That I don't you really don't need to know. And not only that, there's no way to know. When you understand order flow, there's no way to know. Well, maybe I should give you order flow first. We'll see. Let's just try this. Okay, how do prices move? Prices move is a function of simply an imbalance between the buy and sell orders flowing into the pit or flowing into the exchange. It's that simple. When there's an imbalance between the number of buy orders flowing into the exchange and the number of sell orders that flow into the exchange. So, for an example, if we have 10, 11, 12, 9, 8, 7, and the last price is 9. What we have is traders who are bidding at 8 and offering at 10. Now you really have to there's a couple of things to take into consideration. One, there is as speculators. And interesting how we know that we're speculating on price movement and yet do not think of ourselves as gambling, and yet we will define ourselves as speculators, but we're speculators who don't gamble, okay? We're speculating, but we don't gamble. Okay, anyway, what we have is a situation where we need price movement to make money. The price has to move for us to make money. It's that simple. Whereas, for example, there are several market participants who don't want the price to move. These are people who use the markets for legitimate commercial purposes. These are your hedgers. These are people who are naturally long or naturally short, whatever it is that they do for a living. So, for example, if I'm a farmer and I'm planting my corn in the spring, anticipating harvesting it in the fall, think about this, the moment I decide to plant my corn and how many acres I'm going to plant and what I anticipate my yield to be for those acres, I am long corn. I am long the corn market. All I did was decide to plant the corn, and I become long the corn market. Why? Because whatever price fluctuation occurs between the moment I decide it and the moment I harvest my crop is going to determine how much money I get. So if I get a million bushels or 100,000 bushels, whatever the price of corn is when I harvest it is what my income is going to be. So as a farmer, I'm thinking, okay, my cost of production is X number of dollars per bushel. The price of corn, let's say the price of corn is at $7 a bushel right now in April. I don't know what it's going to be in October or November. I have the slightest idea what it's going to be. I'd like it to be $10 a bushel or $9 a bushel, but I don't know. And what I say, $8 a bushel start out with, and 7, let's say at 8. And $8 a bushel, you know what? And my cost of production is, let's say $5 a bushel. Would I be satisfied with a $3 a bushel profit? Yeah, I think I would. So what am I going to do? I'm going to go into the futures market and sell the equivalent amount of futures contracts. I'm selling my crop in advance. So if I'm anticipating, let's say, 100,000 bushels, and one futures contract is 5,000 bushels, what am I going to do? I'm going to sell 20 contracts. If I think I'm going to get 1 million bushels, what am I going to do? I'm going to sell 200 contracts. And what I have done is I've locked in my price at $8 a bushel. If my price is $8 a bushel, I've locked it in at $8. My cost of production is my cost of production is 5. That means I've locked in my profit at $3 a bushel, no matter what the price is in October. But in essence, it doesn't matter what the price is in October because I've got my price already. So the price can change as much as it wants. But what a lot of speculators, people who don't understand the markets, don't realize is that when hedgers enter a market, in other words, what I'm going to show you is that it's an imbalance between the number of buy orders and sell orders that flow into the pit to determine whether the price moves up or down. And because we might only be trading, 5 or 10 mini S&Ps, or even as big traders, we might get into, in terms of shares of stock, might get into pretty significant amount of shares. People don't realize is that there are commercial and institutional entities that can put on orders, massive orders, that can affect the price, affect the imbalance between the buys and the number of sells coming into the pit, and think that they're taking risk that they can't. Nobody would do that because it's too risky to do it. Wrong. It's not risky. They're eliminating the risk. They're putting in orders that can have a huge impact on the price and they're eliminating the risk because they're already naturally long or short. You guys, you sort of with me on this? So, for example, if I got an electric motor manufacturer, and my sales manager comes back with a huge order that he sold these huge generators that are $500,000 a piece or whatever, and he went over some foreign country and sold 10 of them or something. The moment he signed the contract, the moment he got the purchase order, whatever the amount of pounds that it takes to make these of copper that it takes to make these orders, they are short copper unless they already have it in their inventory. Chances are they don't have it in their inventory because, let's say, they're running at high capacity, and what they have in their inventory is just enough to make the orders that they already have. And because they're not even going to start making them orders for 6 months from now or whatever, it's like they don't want to acquire the actual physical inventory of all that copper. What are they going to do? They're going to go into the futures market and buy the equivalent number of copper contracts that they need to lock in the price of copper when they need it to use it, so that they can guarantee their profit margin. That might be a huge order. Now, if I just happen to be trading off a moving average, my technical indicator off a moving average on, in copper, at the time that order hits the pit or hits the exchange, if I'm on the long side, if my moving average just shows me, about 2 or 3 minutes before their order, huge order, hits the exchange, I'm going to find myself in a winning trade. Did my reason for putting on that trade have anything to do with why the market went up? Nothing. Absolutely nothing. It's just what I call like a positive synchronicity. A planned synchronicity with the order flow. Well, let's get into the order flow, okay? So, for example, what does it take? If the last price, so here, I just wanted to make this distinction between speculators and hedgers. Hedgers, when they put an order in the market, they don't want to make the price move. In other words, if I'm this generator, this manufacturer of generators, and I need to lock in the price of copper, to lock in my profit margin, when I put my hundreds of copper orders in the market, I don't want there to create such an imbalance in the order flow to cause the price of copper to go up, because I'm increasing my average price. What I want to do is do it in a way that doesn't create price movement, so that I maintain, my average price, or maintain a good average price. Because what happens is this, is that what you have is that for us as speculators to make money, there's only 2 ways to make money. That's it. Everyone's trying to do the same thing. Everyone has to buy low and sell high, or sell high and buy low. There's no other way to do it. There's absolutely no other way to do it. And as speculators, typical screen-based speculators, we don't have the, let's say in many cases, or in any case really, not many, where we don't have the financial or the psychological resources to actually move the price ourselves. Whereas you have to understand that there are plenty of traders out there who do. There are a lot of hedge fund managers and big traders who can, under a lot of different circumstances, actually create price movement purposefully. They purposefully look for situations for what I call like the herd masters. Okay, where they're looking for patterns, they're looking for chart patterns where they know that a lot of what they call weak longs, you've heard these words, weak longs and weak shorts, have gone into the market, and what they want to do is they want to force the weak longs out so they can get into their position at a lower price, or they want to force the weak shorts out so they can sell at a higher price. And they'll look at chart patterns where they know that the typical speculator has gone into the market. They'll hit the market with huge orders, force the price lower or higher, cause the typical speculator to panic, which creates further movement in the direction against the speculator. But what they need is inventory. And I'll explain how this works. Okay. So, for example, buy low, sell high, buy low. If the last price was 9, how does it get to 10? Yeah, more buy. In other words, look at it this way. If you look at it from the exchange perspective, before there are electronic exchanges, you have executable orders, and for every buy order, there has to be a sell order, or you can't execute a trade. On an electronic exchange, it's the same way. There has to be somebody on the other side of your trade. Whether it's a computer program that was designed by a major brokerage firm like Goldman Sachs or whatever, or an actual individual, it doesn't make any difference. There is somebody on the other side of your trade. In every circumstance, in every single circumstance. Which means that if you buy at 9 and the price goes to 10 or 11, who's ever on the other side of your trade is losing money. The money that you're gaining is the money that's coming directly out of their account to the clearing firm into your account. And when the market goes against us, the money that's flowing out of our account, going into the clearing firm, and going directly into the account who's on the other side of the trade. So what this means is that if the last price was 9, how it gets to 10 is that there were no executable. In other words, I have a certain number of buy orders flowing into the pit at 10. There has to be an executable sell order to match up with every buy order. If you're not getting this, let me know. There has to be an executable sell order to match up with every buy order for the price to go anywhere. If there is an even amount of buys flowing into the exchange at any particular moment with the number of sells as there are buys, the price will go nowhere. You with me on this? If there's an even number of buys and an even number of sells, executable buys and sells at this price, the price goes nowhere. It doesn't go up to 10 until there aren't enough sell orders at 9 to fill the number of buy orders for the people who want to buy, or the number of contracts or shares or whatever available on the buy side. And then the electronic exchange, what it'll do is it'll move the price up to 10 to find sell orders, to find executable sell orders. And if there aren't enough executable sell orders to match the buy inventory flowing into the pit, then it'll move it up to 11. When we were dealing with physical exchanges, people actually did this. In other words, what you had are actual traders in the exchange, in the pits, or whatever, who would actually bid the price up. In other words, if they couldn't find any other traders in the pit who they could execute a trade at 9 at, they'd bid it up to 10 or bid it up to 11 to find someone who would sell. Because the whole idea is sell high, buy low, sell high. So the higher the price goes, the theory would be the more attractive it would be for someone to come into the pit and take the other side of my trade. Are you guys with me on this? So what it all boils down to is that price movement is simply an imbalance between the number of buys and number of sells flowing into the exchange. That's it. That is it. But it has major implications. For example, when I started trading, like I said, in 1978, and I was working in the commercial casualty business. As a matter of fact, I was managing a commercial casualty agency. Just before I moved, pretty much just before I moved to Chicago, I signed a 3-year contract with this agency for $360,000. $100,000 the first year, and $120,000 in the second, and $140,000 in the third. So I mean, I was kind of financially, I was doing good, especially I was in my early 30s, and. But shortly thereafter, something happened. I also didn't like managing. I didn't really like being in the insurance business, and I certainly didn't. I thought I liked management. I did not like management at all. I was a horrible manager. But anyway, just not something my brain was into. But in any case, something happened to me where I felt compelled to move to Chicago because I got a call from like a Shearson broker in the building we were in, and I opened up a commodities account and started trading gold and silver right off the bat. And lost, my first couple of stakes, whatever. I think I started out with a $10,000 account, lost that. Did another $5,000 or $6,000, lost that. Changed my broker, went to a different broker at Shearson, thinking he would do a better job. Had no idea. Remember, this is in 1978, 1979. What we understand about the markets and what's available to us were virtually today were non-existent back then. We didn't even have computers. We didn't even have personal computers. The only way to even know what was going on was to call your broker 10 times a day or whatever. And also, we didn't have instant execution. What you had is a situation where you want to execute a trade, you got to call your broker, you got to dial the phone, he has to answer the phone. If he's on the other line with another customer, you had to wait. And then once he answered the phone, of course, he had to write out a ticket. The ticket had to be wired down to the exchange. Once it got to the exchange, it got to the phone clerk at the exchange. The phone clerk wrote out another ticket and gave it to a runner. The runner then gave it to the appropriate broker executing trades for that particular firm in the pit, and then the broker would, based on supposedly open outcry, actually say, hey, I've got 5 to buy or 5 to sell at this price, and then if someone else, whatever, maybe another brokerage firm or just a local, some guy trading for his own account standing in the pit, hit the order, hit the bid or the offer, whatever the price was, and then the floor broker would record the trade, give it back to the runner. The runner would then go back to the phone clerk. The phone clerk would go call up or wire it back to the brokerage house, and then the broker had to get back to you with a fill. Okay? And all this cost an average with the big firms like Merrill Lynch and Hutton and Shearson like between $130 and $140 a round turn. One contract trade between $100 and $130, $140. Now, I can't tell you how many times I put in an order later on. I mean, just to give you an example, if I put in an order, to buy silver at $9 an ounce or whatever, okay, that I'm buying at $9 an ounce, and the market comes down and hits my price, but I'm not guaranteed a fill unless it goes one tick through my price. So if it hits my price and goes back up, I don't even know if I'm in a trade. My broker doesn't even know if I'm in a trade if the floor broker hasn't gotten back to him yet. If the floor broker is busy, it might take 20 minutes, half an hour. If it's what the exchange classified as a fast market, he wasn't even obligated to get back to me until maybe an hour. I don't remember what it was. So I could be in a winning trade and not know it. I could be wanting to take my profits and not even know if I'm in a winning trade. If I go ahead and just assume that I got filled and, you know, and sold, I could end up being net short, you know, the market's going up and not even know it, you know. I mean, I could end up being net short, not know it. The old timers with the, Tony, you know what I'm talking about, right?
Well, you knew you were going to get your foot for a while, but here's where my stock is. You get your foot on your stock before you find out.
This was a rough way to trade, people. Yeah. This was a rough way to trade. Because not only that, even check out where we didn't have price available. We didn't have any prices available. We had to call our broker, you know, 20 times a day. Where's it now? Where's it now? Where's it now? Basically, what you did was trade off a daily bar charts from the Wall Street Journal. In other words, you get the Wall Street Journal in the morning and you do your, go ahead, Tony.
And we used to have a commodity perspective.
Yes, a commodity perspective, right.
It was a book.
It was a book. Yes.
That was none of this.
And it gave you like 3 or 4 months of bars, daily bars, and it gave you some room on the right there to add your own bars in. Yes.
We remember price.
Yeah.
You know, because at the end of the day, I got to read down there, I trade price. And we remember price that way. Sometimes when you do stuff like that, we're teaching them how. You never do that. You wrote it down, you can remember it.
So yeah, it's like you know, there's things that you learn that you know you sort of take for granted about the way you developed as a result of it. But anyway, this was really a tough way to trade. And so what happened with me? So you do understand the concept that it's simply an imbalance in order flow, right? Everybody with me on this? If there's more buy orders, stuff. So why did the market go up today? More buy orders and sell orders. Why did the market go down today? More sell orders and buy orders. Now, the reason why there were more buy orders and sell orders, how do we know why? In other words, every one of us in the room has a reason. Everyone contributes to the order flow, which means that everyone contributes to the up and the down ticks. Every order contributes to the up and the down ticks. So why did the market tick up? Well, basically the reasons exist in the minds of everyone who put on a trade that contributed to the imbalance between the buys and the sells in that moment. And since the exchange, when we put a buy order or sell order in, since you are not required to attach your reason of putting, you are not required to attach your reason for doing it. What? That's how the what? Oh yeah, make every give the reason. Yeah, right. Yeah, since we are not required to attach our reasons, and neither is anybody else, then we don't know why other people are doing it. And what's interesting is that as typical screen-based traders, we are strictly dependent on what other traders do after we get into a trade. Since we don't have the financial or emotional resources to be able to move the market ourselves, I'll talk more about that in a little bit. Since we do not have these resources, then we are strictly dependent on what other traders decide to do after we get into a trade. And the reality is, we don't have the slightest idea what they're going to do or why they're going to do it. In other words, orders are going to flow into the exchange after we get into a position. We don't know what the volume between, we don't know what the imbalance is going to be. In other words, there could be a huge order that hits the market in our favor, but there happens to be a huge buy order. We just got in. There's a huge buy order that hits the market a few minutes after we get into a trade, but there's enough sell order inventory in that moment to absorb all that buy volume. Price goes nowhere. 5 minutes later, that buy order could create a panic, and the market could shoot right up like this. Why did it happen? Because for whatever reason, whoever put the order in, however many traders did it, and for whatever reason they do it, we'll never know unless we have a way, unless the exchange, the reality is, the exchange, if the exchange gave us the names and the accounts and the names of all the people who contributed to the order flow in any given moment, so that we could go ask these people why they put their orders in the market, then we would know why the price went up or why the price went down. Then we would know the real reasons. Everything else that you hear or read is basically shit that people are making up, and I'm not kidding. And I'm really serious about that. It's stuff that people are making up because they don't know. People don't get on TV or write articles and do it in a way where they don't sound like they know what they're doing, or not gonna do it in a way where they don't sound intelligent or that they know what they're talking about. So even if they don't come right out and say directly, this is why or that's why, they're implying that they know, which gives us the idea that somehow or another it can be known. And there are exceptions, because if you do know large fund managers and traders who can move the market and they do put in huge orders, and you happen to know that these huge orders hit the exchange, and there wasn't enough inventory on the other side to absorb those orders, and that's the reason why the market went up. If you know that directly, then you know why it happened. And certainly the guys or the people that put those orders in, they know why it happened, because they're the ones who did it. For the typical screen-based trader, this information is, for all intents and purposes, unknowable. So the implications are that regardless of how sophisticated your analysis is, regardless of how good you think it isn't telling you the reasons why. Even if, for example, let's say we're trading a support and resistance pattern, okay, or we're trading, we're trading a retracement, okay. So what we have here, and I put a buy order in right here, and the market shoots up. Is it possible that the reason why other traders came into the market and created an imbalance in the order flow is because they happen to put orders right in there too? Yeah, it's very possible. It may even be likely. Is there any way that I know that? No, I don't know, do I? It's unknowable to me. And if you think that what I'm saying isn't correct, all you've got to do is challenge somebody. Every time you hear somebody say, the price went up because of this, other than an imbalance in buy and sell orders, every time you hear somebody give you a reason, say, prove it. Prove how you know that. Where's the information that you have access to that tells you that that's the actual reason why? Tweet the people on CNBC. Tell them to prove it. Say, prove it. I guarantee you they'll shut up. Because they can't. So anyway, what happened to me was I was with my Shearson broker, didn't know anything about trading, and I ended up, I don't remember why he told me I should do this, but I did it. Well, I just did it because I thought he knew what he was doing, but I don't remember the reasons why he told me to do it. I ended up buying silver at it was around $9.75 an ounce. And I bought two 5,000 ounce contracts. So I was long 10,000 ounces of silver. And shortly after I got into the position, the silver market went down to about $9.50. And so I was looking at a $2,500 loss. So what he says to me is that, you know what, we'll take care of the situation. Since I was long two COMEX silver contracts, what we'll do is we'll spread your position between New York and Chicago, and we will go short two contracts in Chicago. So what he did is he put on 2 contracts, another a $280 commission, by the way. So he put on 2 contracts in Chicago. So I was long New York, short Chicago at this price. And he said, when the market goes back in your favor, we'll take the short leg off. Because the whole idea originally was to be long silver, okay? So we'll take the short leg off when the market goes back in your favor. So the market did, it went back in my favor, and he took these 2 short contracts off, but in essence locked in what, a $2,500 loss when he did, right? Okay? That was a realized loss. But then what happened is that the market went back down to $9.50, and he put the 2 back on. What? Now, what I'm about to show you is that in essence, the silver market went into about a 2-week trading range between $9.50 and $9.75. I didn't know what a trading range was. I didn't even see a chart, okay? And I would say that he probably didn't either. Go looking back in the situation, he didn't know what a trading range was either. But what he did do is that every time it went back to $9.75, he took the short leg off and locked in another $2,500 loss. It went back down again to $9.50. He put them back on, and it went back up to say put them on. So he did this over a 2-week period several times. And finally, it got to the point where I couldn't open up my brokerage statements, and I was in an extreme state of distress. And until I got to the point where I just woke up one morning, I said, I can't take this anymore. And I went into my office and I called them up. I said, just get out of them. Just get out of everything right now. Oh man, this is probably the reason why I'm here today. Okay, I'm not kidding. In fact, it is, because about I'd say 20 minutes or half an hour after making this call to get out of everything, the market finally broke out. The market finally broke out of this trading range. Yeah. No, but no, this isn't it. No, this is the worst part of it. The market finally broke out of this trading range, and of course, we never saw this price again because shortly thereafter, within a couple of weeks, you remember the Hunt Brothers debacle? Okay, I was in what you call the perfect trending market. It couldn't, and I say the perfect trending market, I mean it was absolutely, because what's a perfect trending market? One that virtually goes straight up, right? Okay, no retracements? Well, the market couldn't go straight up because the exchange imposed price limits. In other words, the exchange says that the price of anything can't deviate by more than, let's say in silver, I think it was 50 cents a day. I think it started out, it was 50 cents or $1 a day. I don't remember what it was. Anybody remember what silver what the price limit was on silver? Tony, do you remember? Back in the early 80s or late 70s, what the price limit on exchange imposed price limit on silver was a day? Was it about 50 cents or a buck? It had to be a buck. What? Well, yeah, it started out at 50, but it went to a buck. Yeah. Okay. So you know what I mean by limit move? Everyone knows what I mean by limit move. Okay. In other words, when the price went to let's say 10.25, we started out at 9.75. We started out at 9.75. If the price went to 10.25, that's a 50-cent move, and the exchange says, okay, we're not going to execute any more buy orders. It doesn't matter unless there's enough sell orders. Unless there's sell orders, of course, to take the other side. But if there aren't enough sell orders, we're not going to execute. In other words, we're not going to let the price go any further than 10.25 today. Okay? Now we don't know what's going to happen tomorrow morning when the market opens. But in this case, instead of having a bar chart that looked like this, because a bar chart would imply that there were trades within those bars. The silver market in our charts. The silver market looked like this. They were dots. This would be a day. 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 They were dots because there were no trades. Because there wasn't anybody willing to take the other side of these buy orders. In other words, we had a flood of buy orders into the market without any inventory to take the sell side. So the exchange had to move it up the limit for the next day, and then there weren't any sell orders. Limit up again. Limit up again. This would be a perfect trending market because you don't have to deal with retracements. Okay. And then it went all the way up to $49 an ounce. Basically, I was like that close to, in my mind anyway. I'd have never hung out to 49, but at least at the time, I was like that close to what I thought was $400,000 on a two-lot.
And it didn't take long.
And no, it took 30 days or so, a little over 30 days. Now, the reason why this happened is because the Hunt brothers, who were Texas oil millionaires or billionaires or whatever, they got the idea that they were going to corner the silver market. And the way you corner a market is, one, you start buying up as much cash silver as you can. So you start accumulating a huge inventory of cash silver bars, whatever. Okay, and then what they did is they went into the futures market and bought as many futures contracts as the exchange imposed limits would allow them to. However, that was quite a few futures contracts. But see what they did, and the reason why they ended up taking a huge hit on this whole deal is because the exchange said that what they did is they bought more than the limit through other entities that they said they had no relationship with. But the reality is they did. So here's the deal. Here's how a market gets cornered. Is that if there's a buyer for every seller and a seller for every buyer, and at some point, futures contracts expire. And when they expire, if we're not out of our side of the contract, we have to execute the contract. So if I'm on the buy side of this futures contract and I don't get out when the contract expires, I have to deliver 5,000 ounces of silver to whoever's on the sell side at the particular grade that the contract specifies at the price that I got into the contract with. Everybody with me on this? Okay? And as a seller, if I'm not out, I have to take delivery. Well, what ends up happening is that as contracts come to expiration, everyone starts unwinding their trades. Meaning the buyers sell, the sellers buy, and what once existed as open interest starts reducing down to very little, if almost nothing, and the few that are left are the ones that want to take delivery or make delivery. Everyone else had no intention of taking or making delivery, but what the Hunt brothers decided to do was they wouldn't let the sellers out of their contract. In other words, what they did is they'd accumulated tens of thousands of buy contracts with no intention whatsoever of unwinding that contract, of actually selling it before expiration, forcing all the sellers on the other side to go into the cash market and deliver silver to the Hunt brothers. And at that point, the Hunt brothers had so much silver, they're basically having to buy the cash silver from the Hunt brothers to deliver silver on their futures contracts, forcing the price of silver to go up $40 an ounce. Is everyone with me on this? And then when the COMEX said, hey, you know what? COMEX said they said no more buy orders or whatever. Anyway, what went up? Limit up 40 some days in a row, and limit down 40 some days in a row. And the Hunt brothers took the gas on it. They ended up losing all that money. Is that what they did? Yeah, I don't remember what they did exactly.
You're not allowed. At this point, you're not allowed to buy. We're only taking sell.
Yeah, right. They said they're only taking sell orders, right?
Limited extra, limited down, you take it.
Yeah, well, whatever it was, yeah.
Right. And do you mind if I just jump in?
Yeah, go ahead. No, come on. Yeah, go ahead. You need the mic? You need the mic?
No, I don't. I got a good point.
Okay.
The market's going to do. Don't ever think a market can do, always can never do that, because the market can't go wherever it wants to because it can. And during this Hunt brother with silver going limit down 8 days in a row, the chairman of the CME, Jack Sander, had a hog position on it. And there was a report on it. And the report was very bullish. The hog should have gone limit down. It went limit down for 3 days in a row because silver was going down. And Jack Sander was the chairman of the Chicago Market Exchange, and this was limit down away from being bust. And that would not have made the breakout exchange, which was still kind of in its, infancy, shall we say, not even its infancy, but it's still...
Yeah, pretty much though, yeah.
And that would have made the exchange look good. They were limited down for the third day. He walked out of the exchange and went to St. Peter's Cathedral. And came back and the market turned around. But the last thing it doesn't matter what you're trading. Something else, especially in these markets today, something else can go wrong. And you're like, well, why is that affecting my stock? Because it can. Because it can. Psychology has to go in there. Oh, right. Sorry. But anyhow, a market can go wherever it wants. And just don't think that it can't. And I'll throw one more thing out there. In 1987, during the crash, if you were short puts, S&P puts, you obviously got hammered. If you were short calls and the stock market went out 500 points in one day, you got hammered because volatility.
Volatility, yeah. Right. So I've been on the wrong side of one of those. The market's going in my favor, and because I shorted the puts, it was in the D mark, and the market was screaming in my favor, and I'm losing money because of the volatility.
Right. Yeah.
I didn't think. I knew theoretically it could happen, but when it really happened, it's like, oh, okay, this really happens.
These were market makers that went out of business during the crash, and they had lines. They went, oh, their lines. We're broke. We're broke. And they took up the clearinghouse. The next day, I know my husband's cheating on me. Blah 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 blah. I know he's not cheating on you. We will take the fur coat and the ring.
Wait, hold on. Okay, just a little off, but just because you're on the floor. Do you personally know anybody that did a Rio de Janeiro trade?
Oh no, but I never did. But
do you know anybody that did, or
no, I never did.
Does anybody know what a Rio de Janeiro trade is? What do you think of it? What do you think it would be? No. It would be some floor trader who's he's ready to tap out. He knows he's ready to tap out. Now keep in mind, this is at a time before electronic exchanges, before electronic trading cards, where the floor traders didn't have to turn their trading cards in. In other words, all the trades they made during the day, they didn't have to turn it in until the end of the day. And so the clearing firm, the brokerage firm that cleared their trades didn't know where these guys were at, meaning they didn't know how much money they would have won or lost until all these trades are reconciled with all the other brokerage firms that they traded with. And so what they would do is if I'm ready to tap out, I'm going to put on this huge position that I can't afford. And so what they do just before the close, they put on a huge position. Let's say they go long T-bonds, okay? They do 1,000 T-bond contracts. And at the same time, they buy a ticket to Rio de Janeiro. And then what they do before the open, they go to O'Hare Airport, and then wait for the open, and if the market opens in their favor, they come back. And if it doesn't, they get on the plane.
And actually, the way I heard it is, they buy those 1,000 contracts right before unemployment, right before.
Oh yeah, whatever. Yeah, so yeah, where they take a huge guess. Another
And then they go to the airport, and at 7:30, 7:10, they call up. There's the bonds.
Yeah.
I'll be back. I'll be right back. Oh, okay, goodbye.
Yeah.
And I've got a crash ship 87 story of my own that I'll share with you guys tomorrow about the clerk coming up going, "Where's your cards? Here you go. Don't worry, get away from me."
Oh yeah, right.
Get away from me. I went lost, and that's my biggest day ever on the day after the crash.
Wow. Okay, so you guys kind of get the idea here. This business is a lot different than what most people think that it is. Okay, it really is. And and the implications are that if you don't know the reasons why other traders are extending their orders into the exchange, and then you don't know why you're winning or losing. And there isn't any way to find out. Just think about the implications of that. You don't know why you're winning or losing, which means the whole idea of being right is irrelevant. Your predictions can be right, but your reasons for making the prediction are, you don't know, you can't ever verify. You can't ever verify if they're actually correct. They might be, but if you can't verify it, then what's the point of even thinking that you're right? It only gets you into a lot of trouble. Because thinking that you know, if I'm right, it must mean that I know, and if I know, it means I can eliminate the risk the next time. And the risk can never be eliminated. So what happened to me is that I missed out on what I thought was $400,000. This really ate at me. I mean, I can't tell you just how anguished I was when this happened. And so it didn't really take much for me to say, you know what, I'm going to Chicago. And so the first thing I did, I thought, I checked things out, and I found out that Merrill Lynch, their retail brokerage office, Merrill Lynch Commodities, they're on the second floor of the Chicago Board of Trade, and they had 3 positions that are opening. They're going to be open for trainees. And my understanding is they had over 1,000 people apply for those positions. And so, how was I going to be one of those guys that the 3? What I did, because I live in the Detroit area, I went and applied for a Merrill Lynch position at a branch office in the Detroit area. Went through the whole process because they had aptitude tests. So you had to take aptitude tests, but here, the most important part of the process, I thought anyway, was that there's a multi-page application because of the tests, but otherwise there was this box at the back, at the last page, and in this box you had to spontaneously write there was a question that was asked. It was somewhat philosophical. It was somewhat of a philosophical answer because they wanted to know probably how focused and how well you could write something like that under the pressure of being in a job interview. So anyway, what I did is I assumed that the whole process would be the same as the Chicago Board of Trade, and it was. But what I did do is I spent probably 2 or 3 weeks agonizing over every single word of that answer. I mean, and by the time I was done, I even had to admit it was somewhat brilliant. Okay, so I went and applied at the Board of Trade, and of course I aced the aptitude test because I've already taken it. And then if the branch manager thought that I wrote that answer just sitting there spontaneously, okay, because I had it on a 3x5 card, he's got to think, this guy, hey, I'm going to hire this guy. And that's how I got the position at Merrill Lynch. So then people, it's like, no, what did I get myself into? I got myself into a $20,000 a year draw on commissions. That's it. A $20,000 a year draw on commissions. I left $360,000 for a $20,000 a year draw against commissions, and there wasn't anybody in my life that didn't think I was absolutely stark raving out of my mind. Like, how could I do it? It was easy. In my mind, I wasn't giving up anything. Now, it wasn't a revenge trade. I just thought, look, I didn't know anything about trading, and I got myself into a trade that had a potential of $400,000 on 2 contracts. What did I know about the markets? Virtually nothing. What did I know about trading? Virtually nothing. So in my mind, did I give up $360,000? Not really. I'm going to go make this when I get to Chicago. I'm going to be on the inside of the business. And as a result, I'm going to learn how to trade. Only to find out that, especially back then, there wasn't anybody at Merrill Lynch who knew how to trade. Seriously, I'm not kidding. I'm really not. I'm not saying that facetiously in any way. They didn't know how to trade. They knew how to talk about trading. They knew how to open accounts and teach you how to open accounts. In fact, I went through a 30-day training session in Manhattan, and not one moment of that session was spent on teaching us how to trade. It was all about how to sell your customer and how to talk about trading in a way that made it seem like you knew how to trade. So when I got on the inside of the business, I was outraged. Seriously, I was enraged. I really was. It just like, and it took me a while to get over that too. But anyway, the problem is that here, I gave up all this income, and I had money, but it was like, I also had an extravagant lifestyle. I still had a house in the suburbs of Detroit. I had a really nice, apartment in downtown Chicago, not that far from, the Board of Trade. I had a Porsche. I had a girlfriend in, the Detroit area, and, going back and forth every weekend, and, the whole works, right? I mean, just like, just my lifestyle could only be supported if I made money as a trader. Yeah, exactly. That ain't gonna happen. And at the back of my mind, it's like right after I get there, it isn't too long for me to start figuring out. You know what? This isn't adding up. This is not adding up. It's like nobody knows what the hell they're doing with respect to trading. Anyway, I started making friends with floor traders, thinking they knew what was going on. They too direction-related trades, boom and busters too. So all this is like, it's like, whoa. And so it's getting to the point where, as things are going on, and I'm doing, not only that, one of the good things about being at the board, or in that Merrill Lynch office, is that they had a computer, or a terminal actually, that had a direct phone line to a mainframe computer in Boston, I think at MIT, that I could call up a tick chart even on anything at any time. In other words, if this would have been in like 1981, if I wanted a tick chart of wheat on Wednesday, Wednesday, March 14th of 1951, it would give me one. And I'd build a tick chart, all the way to the present moment. And at the time, I was doing point and figure charts. So like I could build up point and figure charts, anytime, they're not based on time, but any box, any reversal size, and it would go back as far as the contract went back. So, and I spent almost all my time at that terminal learning technical analysis, whereas there were like almost, there were over 40 brokers in that office, and I was the only one that used it. I was the only one that used it. So anyway, like I said, things aren't adding up, and it gets to a point where I'm running out of money because of my lifestyle, and to the point where it looks like I'm going to file bankruptcy because I don't have. And the other thing that was so important in my life, even at the time, probably one of the most important things in my life was my credit. I would do anything to maintain flawless credit. Whatever it took, anything. So the idea of not being able to pay my bills was completely unacceptable to me. It was like I believed that if I had to do something like that, I would fall through the cracks of society and never reemerge. You might think I'm just saying this. These are not words. These were a reality in my mind. I could not fathom what that would be like. Just couldn't. But in essence, that's essentially what it came to. Now, if you're thinking to yourself, okay, as you realized that that you're running out of money, and I wasn't running out of money because of trading losses either. I was trading, and and it wasn't because I didn't take big losses. My problem as a trader was because of all the pressure that I had of having to be successful, of having to prove that I didn't make the family, friends, whatever, that I didn't make this asinine decision of leaving $360,000 for a $20,000 a year draw against commissions, that every trade took on the significance of just a degree of